Jim Paulsen is Chief Investment Strategist at Wells Capital Management. Jim, you have about $375 billion under management. I don't know what you're doing with the money today, but help us try to find some sort of ray of light on an otherwise pretty tricky morning.
Well, Adam, we're going to get a lot of data yet this week in the economy. We got probably the biggest week of the month of economic data. So it started out not too good with yesterday's ISM report, but we're going to get personal income today. We're going to get ADP, and we're going to get the payroll Friday, of course, coming. So I think we'll see how we feel at the end of the week here. My feeling is we certainly slowed down here in the first half of the year, but to me, a big chunk of that slowdown was due to one-off events. We know we had really abnormal weather 4 months out of the first 6 of the year. And we also know that there was major impact of the Japanese earthquake and tsunami, particularly on the U.S. manufacturing sector, which is what yesterday's report showed. I think that those are not likely to be repeated in the second half. And so if you take those out of the picture, I think the sustainable growth rate is better than what the first half numbers suggest. On top of that, Japan now is going to become a positive as it bounces over there, and it's showing signs of that with industrial production up, their ISM reports are up, their retail sales numbers are popping back. That's going to help the supply chains here in the United States. I think also what you've done is you've brought energy prices down, you've brought mortgage rates down here, and I think those will combine maybe to pop us above a 3% growth rate here in the second half of the year.
Now, Jim, I've got to ask you, yeah, mortgage rates are down, but they've been down. I mean, that's not new. Well, and oil is still $95. You go to fill up at the pump. I mean, that's $3.50 a gallon. I mean, there's a lot of challenge, a lot of pain out there.
Well, mortgage rates, you're right, they've been low for years, but they came up quite a bit. From the latter part of November of 2010 up till about February this year, they rose almost a full percentage point at them, and now they've come back down maybe three-quarters of 1%. And so that's a pretty big move. On top of that, as you said, energy prices are still high, but they are down some at the pump. On top of that, we're seeing the money supply increase, the M2 money supply increase after QE2, the lagged impact of that. I just think that we're got a sense that we've really died almost close to zero growth. But I also think that a big chunk of that was due to special one-off events. And if you eliminate those, I think the sustainable growth rate was still around 2.5%.
Okay, but I got to jump in. And by the way, it's great to have a bull on the show on a day when there's just red everywhere. But yeah. But honestly, put it into perspective. Where is the growth coming from? I mean, if not from the consumer, where is it coming from?
Well, I think we're heavily influenced by that one GDP revision. But, you know, it's interesting. You know, we said we grew 0.4% in the first quarter now on GDP numbers, but we created more than 200,000 jobs, or right at 200,000 private payroll jobs a month in the first quarter, supposedly. We had, over that period of time, we had the ISM reports over 60% in the manufacturing sector, and we're saying we only grew less than 0.5%. What my point is, Adam, is that's one report, but there's other reports in the economy that would suggest otherwise. Most recently, our unemployment claims here in recent weeks were elevated, but they've now fallen back below 400,000. Which is a good report. Monster.com employment, that index has been rising. The weekly ECRI leading index has started to pop back up.
Okay, so Jim Paulsen.
So there are some things showing better second half.
All right, we have personal income and spending. They come out at about 8:30. We're going to see those numbers. I'm going to give you a call after them. We'll check in then, and we'll see where we stand at this point. But Jim, thank you for joining us. Good luck trading today.